The biggest tax overhaul in a generation is here, and it could save or cost you thousands. But here's the problem. Most high-income earners and business owners won't even realize what they're missing. With 870 pages of legislation, confusion is rampant. And the result is misplanning opportunities, overpaid taxes, and strategic mistakes that could have been avoided. I'm Dan Pascone, founder and CEO of Tailored Wealth, and we specialize in helping high-income professionals and business leaders to optimize their wealth and reduce taxes. And we've analyzed every detail of the new One Big Beautiful Bill so you don't have to. In this video, I'll show you exactly what's changed, what it means for high-income executives and business owners, and what actions you should take now to stay ahead. And for custom guidance based on your specific situation, visit yourtailoredwealth.com. That's where we break all this stuff down based on your income, compensation structure, family size, and state of residence. Now, let's get into it. The first payoff in the new bill is permanent tax cuts for individuals. Let's start with the headline that most people overlook. The tax brackets from the 2017 Tax Cuts and Jobs Act are now permanent. So if you're earning $500K or more, this locks in the top marginal tax rate at 37%. It was previously set to jump back to 39.6% in 2026, which would have added thousands for high-income earners. Let's break that down. A W-2 executive making $800,000 a year would have paid roughly $16,000 in excess taxes per year if this change hadn't been made. That's roughly $160,000 over the course of a decade. Additionally, the standard deduction remains doubled at $31,500 for joint filers, and this neutralizes the need to itemize deductions in many cases. But this is where strategic planning becomes essential. If you're close to the next tax bracket threshold or balancing equity comp, this is the time to revisit your deferred comp options and 401k timing. We run these projections all the time for our clients, and it can be a major needle mover. Payoff number 2 in the new bill is AMT relief and estate tax exemption expansion. And this might be the single greatest win for wealthy families. The alternative minimum tax, or AMT, has hit many executives hard, especially those with RSU income or large incentive stock option exercises. This bill keeps the AMT exemption high at $137,000 for married couples and keeps millions of dollars out of reach of that second layer of taxation. But the real gem? The estate tax exemption jumps to $15 million for individuals and $30 million for married couples, and it's indexed for inflation. That is massive. Before this change, high-income families were staring down a sharp drop in the exemption starting in 2026. We're talking about potential estate taxes of 40% on anything above $7 million per person. Now you've got a much larger window to gift, transfer, and shield assets. This is a great time to review your legacy plan and specifically trust structures and family LLCs. We're having these conversations every week with our clients. Don't wait until 2026 when the opportunity is gone. Payoff number 3 is new family and child-related benefits. This bill isn't just about high-income earners, it's about families too. And there are big changes for those with children or aging parents. First, the child tax credit gets a boost from $2,000 to $2,200 per child, and it's now indexed to inflation. That alone can save thousands per year for larger families. Second, a brand new savings tool called the Trump account. Each newborn born from 2024 to 2028 will get a federal deposit of $1,000 at birth. And parents can contribute up to $5,000 a year with tax-free growth, similar to a Roth IRA. These accounts could be used for education, first-time home purchases, or even retirement. And they offer more flexibility than most 529 plans. Lastly, seniors that are 65 years or older get an additional $6,000 standard deduction through 2028. If you're supporting aging parents or you are one, this change matters and presents opportunities for multi-generational wealth planning. Payoff number 4 is the temporary SALT deduction boost. If you're in California, New York, New Jersey, or any other high tax state, this change is huge. The cap on state and local tax deductions, or SALT, has been raised from $10,000 to $40,000. That means if you're paying $35K in property and state income tax, you can finally deduct it all again. But here's the catch. It phases out for those earning over $500K a year. So if your AGI is above that, you'll either get a partial credit or none at all. And this benefit is set to sunset in 2029. Now is the time to time your property tax payments, coordinate with your tax planner, and potentially bunch your deductions to maximize this benefit. For some of our clients, that's $20,000 or more in immediate tax savings. Payoff number 5 is a permanent 20% QBI deduction for business owners. This is one of the most impactful changes for business owners. The 20% deduction on qualified business income, or QBI, is now permanent. Previously, it was set to expire after 2025. But now, LLCs, S-Corps, and partnerships can now lock in this benefit for the long haul. And phase-out thresholds have been lifted, meaning some high-income professionals like consultants or individual attorneys can now partially qualify. So this is a great moment to review your entity structure. In some cases, splitting business lines or adding W-2 wages can optimize the deduction. We have several clients that we're currently helping to save 6 figures with the right entity setup. Payoff number 6 is 100% depreciation and expanded expensing. Looking to make big investments in your business? Now you can deduct them all in year 1. This bill restores 100% bonus depreciation permanently, and the Section 179 expensing limit has been raised to $2.5 million. That means vehicles, equipment, furniture, even some real estate improvements can be deducted in full up front. This can be a true game changer for cash flow. So time your purchases strategically in 2025 and make sure that your state conforms to these rules. Payoff number 7 is R&D and interest deduction improvements. This one's for the builders and innovators. Full research and development expensing is back. That means if you're investing in new technology, software, or product development, those expenses are deductible immediately. Before this, businesses had to spread those deductions over 5 years. Now, it's all at once. Also, interest deduction rules return to an EBITDA formula rather than EBIT. For capital-intensive businesses, this could restore tens of thousands in deductible interest annually. Pair this with bonus depreciation and you could get some serious balance sheet relief. Payoff 8 is the QSBS enhancements for startup investors. This part of the bill is flying under the radar, but it's big. If you invest in early stage startups through qualified small business stock, your tax benefits just got better. You can now exclude 50% of your gains after 3 years, 75% after 4 years, and 100% after 5 years. Plus, the cap on exclusions rises from $10 million to $15 million. If you're a founder or angel investor, this is the time to structure ownership for maximum tax-free exits. We help clients with cap table planning and exit modeling around QSBS, which is a niche area, but it pays off in a big way. Whether you earn a $500,000 salary or run a $10 million company, this bill changes the rules of the game. And if you don't adjust, you can miss some of the most impactful opportunities that we've seen in years. That's why we've created deep dive resources at yourtailoredwealth.com. You'll find tax strategy checklists, planning tools, and ways to schedule a free consultation. Don't wait until next year's tax return to realize what you've missed. And if this video was helpful, like and subscribe for more guidance and hit that bell so that you never miss an update. We're here to help align your wealth with your goals and keep more of what you've earned.